Today on InvestTalk, we discuss why the Santa Claus rally is likely to turn into volatility as we enter 2025. Then we look at the sell-off in markets today. I also answer questions about Tesla, Regeneron Pharmaceuticals, the S&P Momentum ETF, and more. And at the end, I discuss why Tesla keeps falling behind in self-driving.
This is InvestTalk, independent thinking, shared success.
Now, our main focus point is about the Santa Claus rally and the fact that, yes, that's where we're in, what we're in. But the fact that, 2025 will get here rather quickly, just a few weeks away. And there could potentially be volatility in early 2025. Now, right now, you're getting a mixed economic picture. Manufacturing is improving a bit. Services PMI is cooling a bit. So some balance there. Job market, 150,000 jobs roughly over the last couple of months. Not great, not terrible. And that puts everything from a corporate earnings standpoint kind of in stability mode. And markets like that certainty. And that means there's a clear path towards year end, as I've been saying for a while, that things are likely to hold together. But if you look at valuations, when valuations are elevated like this, when you're approaching mid-20s forward-looking earnings, that is relatively high, and that sets the market up for disappointment. Now, what you have to understand is valuations are terrible timing mechanisms. So never sell because of valuations and think that you're gonna get the top. That's not how this works. Okay, it's really about expectations being built in, and then those expectations not living up to par, as well as potential catalysts that will create a negative shock that brings the market back down as a lot of weak hands are invested and they run for the hills. Okay, so as long as the economic growth persists, rate cuts continue, corporate performance is stable, don't think that there's going to be volatility, because there probably is not going to be, right? It means that every little dip is more of a buying opportunity, as it's been throughout this year. But as 2025 approaches or commences, volatility is more likely to pick up as you get deeper into the year, especially post-election or post-inauguration, as the new administration comes in, and there's going to be surprises of how policies are proposed and implemented. And what's even more important will be the order of operation here is, what policies are economically stimulative versus economically detrimental. There will be both. And the process of which ones are passed and implemented will certainly have a large impact on potential volatility. For example, if tariffs are implemented right away, which are obviously economically negative, if they are implemented well before the tax cut extension, well, that could mean more volatility in the near term. But vice versa, you could easily see Trump coming in. You have the debt ceiling fight that could be discussed in conjunction with the extension of the Tax Cuts and Jobs Act. And if that happens and the debt ceiling fight is not very material to government spending, then that could be stimulative. And that's why you go into next year, you have to be open to many outcomes. Okay. And as you get deeper into next year, that just means more time for geopolitical saber rattling. You have tariffs being perpetuated and implemented. And you also have just headlines that could shake things up a bit. And as you get into the second half of next year, that's when you get the refinancing of corporate debt in a big way and into 2026. And that will take a lot of liquidity out of markets and also have a potential for some more volatility. So what I've been telling clients, talk to one today, so 2025, is probably not going to look a lot like 2024. You've had back-to-back double-digit positive years with minimal volatility, and you have a new administration that's likely inflationary with a secular inflationary backdrop. And then you have that corporate refinancing situation in the back half of next year. Now, those are just things on the radar. There are going to be topics that come from left field. Nobody's talking about right now. That can both be positive and negative. Okay. So right now, what's driving markets, the Santa Claus rally, it's a lot of structural shifts, structural factors, shall we say. But as we get into next year, those structural factors kind of dissipate as we get past OPEX in January, which is, remember, the third Friday of January. And then things loosen up, and I think there could be more volatility. So that's what we're watching for as we head into 2025. Let's take a quick look at the markets today. You had the Dow down 86 points. The NASDAQ was up 23 points, about 0.12%. The S&P was basically flat, down 0.16 points. So you had some big gainers. You had Broadcom up 24%. That was the biggest driver of the positive inflection on the S&P. The biggest loser, Airbnb, down nearly 5%, and Nvidia was down 2.3%. That was the biggest drag on the market as well. Tesla was up 4.3%, Palantir up 4%, and Amazon was down about 0.5%. Same with Microsoft, and Meta was down 1.6% as well. What were other big movers here? Home Depot was up slightly. Alibaba was down 1.5%. So the Chinese stocks continue to struggle despite the recent stimulus on that front. So that was the market today as we head into the weekend, and we're getting a, like I said, a bit of choppy environment, and it doesn't shock me, right? The market's overbought. There's not a lot of catalysts for a big drawdown in markets, at least near term. But when you're overbought, then it's harder to make headway to the upside. So it's kind of where we're in now. We're in a very choppy market.
Hey guys, love to get your thoughts on Kraft Heinz, ticker symbol KHC. Just looking for it to hold it for a long term. Thanks.
All right, looking at KHC, Kraft Heinz. I know this is a Buffett holding at one time. I'm not sure if he still owns it. And they had some accounting issues, and that's always something you want to kind of avoid. Okay, but overall, this is a name that makes all the popular products on your store shelves, or many of them anyway. Right? We know they make ketchup, but they make Oscar Mayer, Velveeta cheese, Philadelphia cream cheese, etc. And it's a steady business. It's a mature business, but it's a boring business with not a lot of growth. Earnings in 2018 were $3.54. This year, earnings are $3 and a penny. Now, that's up from $2.78 in 2022, but you're talking about low single-digit earnings growth. And so that 5% dividend yield sounds great. The problem is that it's just a business that is struggling, and we have a new administration that is with RFK looking at the inputs to food costs or inputs to food, and how that relates to our health. And companies like Kraft Heinz are going to be really in the crosshairs there, and that what worries me a bit. And then you look at the profitability. Return equity is only 3%. And so when I look at that, it's just too low for me. I need a company that's a lot more profitable. They still have a lot of debt on their balance sheet, about $20 billion in net debt. So a lot of that cash flow is going to pay down their debt. $3 billion in free cash flow, that's good. But on an enterprise value of $57 billion, that's not really that great. You're talking about a 5% free cash flow yield with no growth. The stock is trending lower, making a series of lower highs and lower lows. I just see no reason why you want to get into this name. Remember, there's something called opportunity cost. When you have money in a position, you could have that money elsewhere. And so there's just a lot of better places to allocate your capital here that are more profitable, have a better balance sheet, don't have the regulatory concerns of the new administration. etc. So so don't get roped into this 5% dividend yield. This looks like more of a value trap than anything that is attractive. So I would 100% pass on Kraft Heinz. Now, when people take the time to leave an InvestTalk podcast review on iTunes, I'd like to thank them for their courtesy by getting to their questions quickly. Now, Gummy Bears and Scotch says, I love that. That's a great username. Gummy Bears and Scotch. I've accumulated about 1,000 shares of Tesla, average cost $182. I started selling covered calls on those shares. They're now $310. My question is this: how would you unwind these covered calls? What I would do is I would try to roll these close to expiration. So luckily Tesla doesn't pay a dividend, so you're not going to get called away because of ex-dividend or anything like that. But as you get close to kind of the last week before expiration, I would try to roll those out and up. So out to the next month or two expirations, and then up maybe $5, $10 to do that. And you'll get paid oftentimes to do that as well. So that's how I would do it. You remember, when you sell a covered call, you're in the money. You do not have to allow that position to be called away from you. You can roll it. You can always buy back a position. When you're selling a covered call, you're just short the call option. And then just like a stock, when you're short a stock, you have to buy it back, and you can buy it back. You can buy it back at any time. And so a lot of average investors get too in their head about this stuff. You can manage your way out of it over time. Let's keep things going and play another listener question now.
I'm calling today about Onto Innovation, ticker symbol ONTO. It's rallied here lately with the semiconductor and the AI, I believe. It is a small cap stock, which I like. It's done pretty well for me. I was wondering if you could just take a look at it and let me know if you believe it is overvalued, fair valued, if you think I should hold on to it, or if I should take my profits. Thank you for your time. Bye.
All right, looking at Onto Innovation is the symbol. And this has actually been in a downtrend since July, peaked out around $240 per share. Now we're at $167, near the lows over the past few months. And it's frankly consolidating bearishly. So it does look like it wants to head lower. Earnings are generally in a positive trend, but they are choppy. Last year, earnings were down 32% from $552 in 2022 to $373. This year, full year, expect to make $5.24 and then $6.69 next year. But those estimates are coming down as well. Now, what do? They design, develop, manufacture high performance control, metrology, defect inspection, lithography, and data analysis systems used in microelectronic device manufacturers. So it's electronic manufacturing equipment. And we know that business is fairly cyclical. Now it's a $8.2 billion market cap. You said it's small cap. I would say $8 billion is more mid cap. So I like the mid cap space. I'm fine with that. Profitability, a 10% return on equity. Now, over the last 10 years, that's about average. It did dip into negative territory during COVID, but that's to be expected. But, return on equity in around the 10% range, it's okay. It's not amazing. Now, the good thing here is they have a good, solid balance sheet. That's good. But their free cash flow, $220 million, it's not a very high free cash flow yield. You're talking about a 2.5% free cash flow yield. That's not great. Price of sales around 8.8. You have enterprise value EBITDA around 31. That's very high. So everything lining up here is telling me the technicals are poor. The valuation is high. Earnings trends are headed lower. And I think the stock is probably headed lower too. So I'm passing onto innovations. I just don't like the stock trends or that valuation. That was ONTO.
I'm calling to ask about a refinance that I'm currently in the middle of. So I'm refinancing a rental property that I own. And I was wondering, because I do have a good bit of equity in that property, and I haven't quite been maximizing my Roth contribution every year. So would it be smart to take some of that equity out of my house and actually just put it into my Roth IRA where I feel like it can make better returns and possibly beat what my home might be able to bring in terms of equity in the future. Look forward to hearing your answer. Thanks so much. Bye.
Yeah, I wouldn't mind if you're already doing a refinancing and you're cashing some money out for whatever reason. I wouldn't mind a little bit to fund a Roth IRA. But remember, you're talking $7,000 a year, $8,000 if you're over 50. It didn't sound like you were over 50, but $7,000 a year. It's not much to take out. I wouldn't do it specifically to fund a Roth IRA, but it does help with tax diversity when you have, I'm assuming, a 401k, IRA, and then a Roth IRA, as well as rental properties as well. You have various options of how and when to take money out from a tax perspective, and that creates that tax diversity. So yeah, I wouldn't mind that, but like I said, it's a very limited amount that you can contribute to a Roth IRA. I mean, you also have to have earned income. So don't think you can make a Roth contribution just because you have the cash. I'm not sure if you have a job, earn income that way or not. Maybe you're just living off rental income. I'm not sure. But yeah, make sure you have to have earned income to make those Roth contributions. Thanks for the call. Now, on Fridays, we generally make time to fit in a rundown of some key benchmark numbers. So let me hit this list for you now. The 2-year yield was at 4.2%. Last week, it was at 4.11%. So pretty decent move in the 2-year. And the 10-year up to nearly 4.4% of the close today. Last week, it was at 4.16%. So nearly a 25 basis point move on the 10-year. That's a pretty big move. Gold was priced at $26.45 an ounce. That was up slightly from $26.34 last week. And 145 weeks ago, it was at $1,806 per ounce. So continues to be in an uptrend overall. Silver, $30.56. That was down a bit from last week when it was right around $31 per ounce. And on the oil front, $71.29 last week was at $67.42. So pretty sizable move in oil prices in just 1 week by about 6%. The national average for a gallon of gas, $3.02, down 1 cent from last week. Here in California, we're paying $4.33 compared to Iowa. They're only paying $2.70. So us in California, we're definitely taking on the chin when we are at the pump. Now let's pivot over and talk a bit about the deficit. And we know that the Trump administration has some pretty lofty goals when it comes to cutting the deficit, economic growth, et cetera. Okay. And due to the budget deficit, a lot of investors are staying away from longer dated treasuries, 10-year, beyond, and sticking with shorter duration. And that's what we are doing for our clients as well. But the Congressional Budget Office forecasts that U.S. debt to GDP ratio could exceed 200% in the next decade. Mainly, this is driven by demographics. The boomer generation retiring, healthcare costs, Medicare, Social Security, all of that projected to be the main contributors to the rising spending. Now, the Trump campaign promised to reduce the current 6.5% budget deficit to 3%, while also extending the Tax Cuts and Jobs Act, implementing further tax cuts, and achieving 3% real GDP growth. Now, all of this is very difficult. All of that is very difficult in conjunction. Okay, so reaching a 3% deficit would require $875 billion in budget cuts. Okay, and if you are going to do that, then you are going to need to drive nominal growth of the economy to 9% in all other GDP categories. So how GDP is calculated, you have consumer spending. That's always number one. It's the biggest. Then you have investment. So that's typically companies going in, building buildings and investing in the means of production or services, right? Number 3 is government spending. Okay. And then net exports. And net exports are typically a drag. So what the Trump administration is going to need to do is reduce the deficit, the trade deficit, excuse me. I say deficit, I mean trade deficit. So they could do that. And they could do that with tariffs, right? That bring more money into the government. Now, I'll talk in a little bit. It's not very much, but it's something. Investment is going to have to go up. So that could be, there's already a major amount of investment in new production facilities in the US due to the CHIPS Act and the Inflation Reduction Act, a lot of incentives there. And then there's the consumer, which has a strong balance sheet, but how can you get them to really spend a lot more than they already are? We're already humming along in a good clip there. So it's going to be very difficult for a $875 billion cut to spending to not trigger a recession. Okay, especially because if you think of post-financial crisis, the average nominal GDP growth is about 3.5%. So they're going to need to get that up to 9% while making those cuts. Very difficult. Now, discretionary spending itself, this excludes interest payments, was roughly $900 billion. So if you're cutting $875 billion alone, that's basically wiping out all discretionary spending. There'll be no funding for essential services, including defense and education. Now, they can do a few things. They can roll back parts of the Inflation Reduction Act. They can implement tariffs, like I said, and they can make more mild changes. So, for example, extending the Tax Cuts and Jobs Act 10 years would increase the deficit by $4 trillion. If they only did that for 4 years, it would be about $1.8 trillion. So maybe a modest increase there. If they repeal the tax credits for clean energy, that could be between $100 and $400 billion over the next decade in savings. Now, that's over the next decade. It's nice, but you're talking about trillions of dollars in deficit. You're talking about annually, 100 to 400 billion over a decade. You're talking 10 to 40 billion per year. That's a drop in the bucket in our total deficit. Now, the Government Accountability Office has identified between $400 and $500 billion annually in inefficiencies in healthcare and defense. That's probably the lowest hanging fruit here, is the defense procurement process, cutting out waste there, and streamlining Medicare, Medicaid, and lowering prescription drug costs, et cetera, that can really bring down a lot of those inefficiencies. That's probably where they'll make the most hay. Now, the tariff front, as I've said, that I think that can help net exports a little bit. And it could generate about $400 billion in tariffs over the next 10 years. However, that's over 10 years. Once again, you have $1 trillion deficit. Tariffs could cut, maybe 10% of, at most, in the best case scenario, off of that deficit. More realistically, in the 3 to 5% range. So this is how the Trump administration can make progress. It's going to likely be more incremental as opposed to a balanced budget. To say we're going to go to a balanced budget and cut $2 trillion in expenses, it's just not realistic. But I think there's a lot that can be done. It's just a matter of, is this the administration that's going to truly make that happen? Now, I'm going to get to a YouTube comments question in a few minutes, but first, let's slip in another listener question from 888-99.
I'm calling from England. Wondered what your thoughts were on Regeneron Pharmaceuticals. It's R for Romeo, E for England, G for Golf, N for November, REGN. And wondered what a decent entry price would be. Thanks a lot. Bye.
Ooh, okay. This is interesting. This is a name that is down significantly in just a few months. It peaked out in, what was the date here? Late August at $1,200 per share and change. Now it's at $730 per share. So you're talking about 40% off its 52-week high in a very relatively short period of time. Now, this is about an $80 billion market cap. And what they do is they discover, develop, and commercialize products that fight eye disease, cardiovascular disease, cancer, and inflammation. Now, is there something going on with some of their products? That's a bit of a worry for me. And the technicals here are terrible. And the valuation still isn't cheap. Now, they have good, strong balance sheet. Free cash flow is $3.3 billion. But that's not on a $73 billion enterprise value. That's still not super attractive. And the technicals are downright bad. Relative strength is at 9. No dividend here. And earnings expectations for next year are now flat and headed lower. So this to me looks like something that has more room to the downside. Let me get you a support level. This is a tough one because the momentum to the downside is swift, shall we say. Now, there is good support around $627 per share. That's $730 now. That would be major support. But I'd really want to know what is the cause here. I haven't looked at that. I've seen this one throughout the years. I don't know exactly what is going on with this name. And until I wrap my head around that and can understand why this momentum is so terrible, I would absolutely pass on Regeneron, REGN. Thanks for the call. Now I'm going to go to a YouTube question now. Rue Junking says, I started learning investment from your program 3 years ago. Brilliant, helpful program. Thank you so much, Justin and Luke. I'm not sure if you could take a look at UMC. ADR, do you think does this company have a chance to grow? Now, this is another one. Its technicals are pretty bad. It peaked out back in also late August, early September. And that was at $8, almost $9 per share. Now we're at $6.39 per share. So also down considerably from its 52-week high. Let me pull this up here. Much smaller company, about $16 billion versus Regeneron was $80 billion. But still good size. Earnings, though, this year are supposed to fall 22% and down another 1% next year. And those estimates are coming down as well. It's a Taiwanese company who manufacture IC integrated circuit wafers for telecom, consumer electronics, PCs, and more. Now, my issue with this type of name is it tends to be a price taker, meaning their margins tend to be pretty poor. Free cash flow is negative, very capital intensive. Its free cash flow has been negative since late last year and doesn't look like it is recovering. Return on equity is 14%, but that is also trending lower from a high of 30% back at the end of 2022. So I don't like the trend in the stock price. And this looks like it wants to head at least to 550-ish or so, which is the low from middle of 2022. And the positive here is the balance sheet is pretty strong. The multiples are fine. However, like I said, the trend in earnings are reflecting negatively. So I see no reason to get into this name, and I would pass on it. There's a lot better opportunities for you in the market right now. Now let's go take another YouTube question. LibTRS838 says, hi, what do you think of SPMO? It is a S&P 500 momentum ETF. It seems to have better performance than the standard S&P 500 index and smaller drawdowns. SPMO. Well, it depends on your time frame. Let's go look at the performance here. There we go. Now, what they typically do is they filter out for, once again, momentum, stocks that have positive momentum, and they get rid of those that have low momentum. Let me look at usually it's the top 100. Yes, this is about 98 positions. So the top 100 in momentum, they filter out the rest. Now, if you look at the performance, they have different processes. This is a up 48% this year, which once again is certainly better than the broader S&P. In 2022, it was down 10%. The broader S&P was down 20%. So it certainly did better then. Last year, however, that wasn't the case. Okay, it was up 17%, whereas the index was up 26%. Okay, so not every year it's going to outperform. In 2021, the index is up 26%. This was up 22%. So slight underperformance there. 2020, it outperformed. Index was up 21%. This was up 28%. So it's certainly a mixed bag. It doesn't in this year. Yes, that certainly has worked out well. In a choppier environment, it will tend to underperform. So understand that, and that's very common when you're taking more risk. That's what momentum is, right? You're not worrying about valuation. You're just following price, and that can work out very well. But when things start to come back down to earth, the liquidity dynamics in the markets become tighter. Then those higher valuations tend to weigh on the stock price, and the model has to be quick enough to pivot out of those names before taking large losses. So don't think that it is free. It's just taking more risk. That's what you're doing here. You're just taking more risk, and if you're okay with taking more risk, then there's nothing wrong with holding this. Thanks for the question. Now, lastly, let's talk about robotaxis. And this is something that a lot of Tesla bulls have been excited about. And we had the robotaxi event a few months ago. And Musk's plans with the robotaxi really relies on end-to-end artificial intelligence. What he wants to do is Teslas have a lot of cameras on them, okay? And he wants to feed that into AI supercomputers, to learn how to drive safely. And he continues to promise these tight windows for rollout. But even he says, quote, "I tend to be optimistic with time frames," end quote. So he's predicting production of the robotaxi by 2026. Well, odds are good that's not going to happen. Why is that? Because if you look at the leaders in the space of self-driving, Waymo. Now, what they have is something very different. Their process is very different. They have more, they look at not just video, they look at the sensors on the cars, mainly LiDAR, lasers, okay? They have laser sensors, and they are far more accurate. They also have radar, and it gives the company's cars, Waymo cars, a much richer view of the world. And it allows them to teach their vehicles by correcting them as they do the driving themselves. Whereas Tesla is betting on AI technology itself reaching levels of sophistication that they're not out yet. Being able to process all of this driver video data and teaching the algorithm how to drive. But there's one big problem with that, beyond just the capacity, the bandwidth to process this video. But it's okay if something goes wrong, there's not really a way for them to figure out why it reacted that way, because it's based on thousands of hours of video that it's just learning from, versus when you're looking at sensors, you know why it made that decision, because sensors said X, Y, and Z, and then you can adjust how the car reacts to the various sensors. And so that's why you continue to see Waymo and others surpass Tesla in their ability in self-driving. Well, that does it. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. It's InvestTalk. Enjoy your weekend.